Hey everyone, welcome back to Yuri's Box. In this video, I'm going to talk about what is the yen carry trade. If you like this kind of content, consider leaving a like. And as usual, nothing in this video is to be considered financial advice. I apologize for the raspy voice, but I have the beginning of what seems to be a cold. And I was planning on making this video either tomorrow or the day after tomorrow, but my schedule is quite full, so I decided to make it now. So if you follow this kind of these kind of events, or even if you just heard it on the news and you're not particularly involved in in the financial world, you'll recall that ever since last summer we had some turmoil in markets, particularly around July and beginning of August, and it came as well with the some drama from the non-farm payroll release on Friday 2nd, where we had the beginning of what seemed to be a growth scare in the US. But if you look closely, we had the yen strengthen rapidly ever since July 11th. And if you go and look, at what happened on, let's say, the QQQ, Nasdaq, precisely July 11th is when you saw, the turmoil begin, and again, it kind of coincided with the end of with the release of non-farm payrolls. Now, again, if you've been on X, you'll know that the biggest proponent of this of the risks connected to the yen carry trade is Michael Gayed. I hope I'll make the topic in justice. So I'll just get the most useless and irrelevant thing out of the way. The reason why I have this trend line right here is because this move really reminds me of something that I saw back in 2021 when I was starting out, and it was basically the move we saw with Bitcoin. Okay, just keep this in mind. And the minute I saw it, it reminded me exactly of this move right here. We had a crash, then slightly downward move, a big rally, a bounce off of the bull market support band, and then another rally. And then we tried to hold support right here. We just fell right through it, and we kind of continued on with the downward trend. Going back to the yen, where are we? Right here. Again, you see something similar. You see slightly downward move, a rally, a bounce on the bull market support band and the trend line, then another rally, and then try to hold support, and you just break through it. Okay, I just wanted to to put that out there. But as far as the yen carry trade is concerned, why is it a potential risk? So first of all, you have to ask yourself what goes into a currency pair. Okay, so in this case, the US and the yen. A lot of things is the answer. Mainly interest rate policy and the differential between what is interest rate policy in country A and country B. So as far as the US dollar and the yen is concerned, you have two very different situations, because prior to last year, interest rates in Japan were close to zero, or at zero, if I'm not mistaken at all. Let's see right here. Yeah, so until February of March, there we are, we were at zero now, or negative. There we go, even better. The more the merrier. And the reason why this is important when talking about the yen and US dollar pair is because in the US, if you've been following, you'll know that interest rates were exactly the opposite. You had a huge spread between the two. Now, what does that mean? Well, imagine that you had to choose where to put your money. Would you put your money in a market, let's simplify everything, that is yielding 5%, or in a market that's yielding negative yield? The answer is, of course, something that's yielding 5%. And so that is what you've actually seen ever since, well, really 2020, if I'm not mistaken. Just looking at the yen pair, okay, that's what you've seen. And this has been going on for quite a bit, okay. But just looking at recent history, what you've had is a fairly significant devaluation of the yen. Okay, so whenever this chart is going up, that means that the US is strengthening against the yen. So $1 buys you more yen. And whenever you see the opposite occur, the chart going down, you have the yen gaining value against the dollar. Okay, so $1 buys you less yen. So again, getting back to interest rates, just for simplicity's sake, you can imagine that is what caused this massive devaluation. Now, what does this massive devaluation, what are the consequences of it? Well, again, going back to the example that I gave you before, if you had to choose a market to put your money in, what would you do? You go into the US. But something saucier, you can come up with something saucier. You can borrow yen at practically zero and go to the US. And whatever spread you make, because again, it's not like you're paying 3% and you're making 5% and you're pocketing that 2% spread. You're paying 0 and you're getting 5. So you're getting all of it. Okay, so that is a big deal. So imagine you have Bob. Bob goes to Japan and he borrows X amount of yen, and he goes to the US and he goes shopping. He buys the Nasdaq, he buys treasuries, he'll buy small caps, he'll buy everything, okay? And as everything goes, you have people, looking for more and more yield, especially when you have a situation where you have interest rates in your own home country that are at zero. You know that your currency is getting devalued, and what you'll want to do is just get as much yield as you can. Okay. Now, one place you can get that is high yield credit. Okay. Now, just to make this simple, okay, the chart that you have in front of you is basically credit spreads. Okay, a representation of credit spreads. What are credit spreads? Okay. Take your let's say poorly rated bond issued by, let's say, a small cap, a small business that's trying to raise capital, and compare it to something of the same maturity on the treasury curve. Okay, so let's say that you have a 10-year treasury, okay, yielding 4.25, and a 10-year bond issued by your small company that's trying to raise capital. This spread here of 2.88 is the premium that is put on top of 4.25. And why do investors ask this spread, this premium? Well, because if I'm getting 4.25 and it's free of risk, and I have to choose between the risk-free rate and this right here, I'll want an extra yield on that as a compensation for the extra risk I'm taking. Okay, so as far as the credit spreads are concerned, whenever you see credit spreads at low, like we are today, okay, we are at historic lows when it comes down to credit spreads. What does this mean? It means basically that the risk that is perceived is quite low, because if the perceived risk is high, well, then I'm just gonna have to ask you for more premium. I'm just gonna have to ask you for more yield on top of that risk-free rate. Okay, so keep this in mind. At the same time, proponents of the yen carry trade, like Michael Guyot, and I'm sure you've read his tweets if you're on X. It's impossible to ignore. I follow him. I love him. But again, plowing through. On the flip side, you have again the small cap index, the Russell 2000. Okay, now the Russell 2000 again is kind of representative of the stocks that are asking you for the stocks of the companies that are asking you for that yield. Okay, for what we just saw now in credit spreads. So again, the Russell 2000. At a glance, you might say, "Oh, okay, things have been kind of flat, but they had their rally, and it's okay. Yeah, there might be a little bit down now because of the recent turmoil. But what seems to be the problem? Well, the problem is very simple. If you look at something like the S&P 500, okay, even taking into account the latest drawdown that we had the last few weeks, ever since their 2021 high, we're still up 20% roughly, okay? And from their peak, we were really at nearly a 30% extra on top of the 21 peak. But if you go and look at the Russell 2000, at best, we matched that peak, okay, in 2021. And we got there in December. And if you keep in consideration what we've had in the last few weeks, we're down 16%. Now, why wouldn't the small caps rally? Well, potentially because they are telling you something that is completely opposite to the credit spreads that we saw before. Okay, this is what many proponents of the yen carry trade will point to you. Credit spreads are telling you there's no reason to be concerned. There's low probability of bankruptcy and stress in this area of the market. But yet the stocks of those companies that are asking you for that for that extra yield have performed extremely poorly. Okay, so the question that arises is who is lying? Okay, because one has to be right. Either perceived risk is low, and so therefore the Russell 2000 should be rallying quite considerably, or risk is high, and credit spreads should be potentially blowing out, like we saw. Well, again, not blowing out, but at the very least, they shouldn't be at historic lows. Okay. And whenever you see credit spreads blowing out, like you saw in 2008, like you saw in 2020 during the pandemic, like you started to see in 2022, that is generally associated with times where markets are in deep turmoil. Now, how does this connect back to the yen carry trade? If you are someone that has participated in this kind of trade, let's say that you've borrowed yen, and you've bought dollars, and you've bought dollar-denominated assets with them. So, as long as the spread between interest rates between Japan and the US, okay, let me see if I can put it up here like this so you can see it better. I don't know why it's really. Here we go. Okay, so don't get fooled. This is 0.5. Okay, let me just reduce it so you can get the real picture. So as long as the differential between the two is high, you're really even gaining on the currency pair. Because think about it. As long as the currency you borrowed is getting devalued against the currency you bought, you have to hand back less of the original currency. Okay, so you're even making a profit on just simply, the exchange, on the exchange rate. But if the opposite is happening, okay, you have strength in the yen, you have to hand back more yen, and you have to sell those. You get so-called margin called. You'll have to sell the assets you bought so that you can give back the original amount in yen that you originally borrowed. Now, what would cause a strengthening in the yen? Just by looking at interest rates. Okay, Japan has been going through basically what we went through in 2022. Okay, so you don't even have to know a lot of Japan's history, but for a long time they were struggling with deflation. Okay, and so they had rates at zero for quite a long time, and they were begging for inflation. Well, they got it. So, like everyone else in like the rest of the world, especially lately now, they've had a significant rise in inflation. Okay, now what does that entail? It entails that you have expectations for interest rates, well, kind of blowing out, because again, as long as inflation isn't a problem, well, interest rates can stay where they are. But if inflation starts to, go back the other way and in a manner that is not too good, well, interest rates can only do one thing, and they can go up. Okay, so that's what you've been seeing actually ever since last year. You've had across the curve really in Japan, 10-year as well. I mean, pick your poison. Interest rates in Japan have been going up. Okay. Now, what does this mean? It means that as the spread between Japanese and US interest rates narrow, the yen strengthens. Okay. So the more those interest rates get closer to each other, so if Japan has to raise interest rates or the US has to drop them, it actually causes the yen to rally. And this actually brings us back kind of to one of the initial things I mentioned, which is the non-farm payroll print that got released in August, and the stress that we saw back then. Because one of the things that the yen carry trade is based on is that the economy in the US continues to chug along. Okay, one of the enemies of the yen carry trade is an economic slowdown in the US, because if that happens, the Fed will have to drop rates, and by dropping rates, you'll have just the U.S. interest rates getting closer and closer and closer to the Japanese interest rates, which will cause the yen to appreciate, as we've seen before. And as the yen appreciates in value, people will get squeezed. So, and those people bought, again, as we saw before, high yield credit. They bought stocks, everything, anything they bought, they have to sell. They have to bring their money back into the yen and pay off the initial debt that they got at an increased, actually pay back more yen, because again the yen is strengthening against the dollar. Okay, so that is another reason why, like I said in yesterday's video, again, not strictly related to the yen carry trade, because this kind of falls into the black swan event. Okay, everybody's been looking at it, and it'll happen if it has to happen, whenever it happens. Okay, maybe because I've just made a video about it now, it'll never happen. This will just be the bottom in the yen carry trade fears. But again, it's one thing that you have to keep in mind, and because we are in a kind of a slow patch for the U.S. economy, you actually do have one of the two ingredients um, potentially playing out. Now, again, the first ingredient that I forgot to mention is, again, inflation going up. If you see Japanese inflation continue to go up, that just means that interest rates in Japan are going to have to go up to counter that. And you've already seen comments being made by former heads of the Bank of Japan along the lines of, we'll have to probably raise rates faster than we originally thought, and probably by more. For now, the target is 1%. Okay, they plan to reach 1% by the end of 2025, if I'm not mistaken. While we're looking at Japanese interest rates, one curious little thing to point out is that usually the Bank of Japan is kind of the last one to be raising rates, and they seem to be to raise rates just by looking at 2008. They actually raised rates right into 2008. Okay, so they're really kind of the last ones to move, and the same thing has happened this cycle, and we'll see. The last numbers for inflation have been quite bad for Japan, just signaling the fact that, again, interest rates have to go higher, and that's what you've been seeing. And as a result, the Bank of Japan has to chase after it. Okay, so, and again, as I pointed out in one of my previous videos, central banks aren't really in the business of anticipating things. They're in the business of reacting to things. That's all they do, and it's not a bug of this or that central bank. It's a feature of every central bank. Okay, that's all they do. So again, if you have either inflation going up in Japan or a slowdown in the US, you have reasons for the spread between Japanese and United States interest rates, having to narrow, and that'll just cause the yen to strengthen. Okay, so that'll be manifested by this chart going down. And if the yen strengthens, people that bought risk assets in dollars will have to sell those risk assets, and in order to pay back the extra yen that they end up owing due to the strength. And again, the best way you can see it is what happened in July and August last year. Okay, yen starts to strengthen right here. It strengthens all the way down to here, and the Nasdaq follows, and the S&P follows, and Russell 2000 follows. I'm curious to see actually what happened in credit spreads, because I don't really remember. But I don't think we had any major blowout or anything. Well, kind of. I mean, we started to see them widen a bit, but it wasn't really anything dramatic. Okay. But again, this isn't really anything to again, I'm not saying this isn't something that should make you go out and say, "Oh, I'm gonna buy canned tuna and corn and a bunker and hide under a rock for and wait for the yen carry trade to unfold." It's just something to keep in mind. It's also something fun to talk about. And the only thing you can really do is wait and see how it plays out. Of course, this is connected also to a potential risk-off scenario with bonds, because of course, if you're selling, forget selling. If there's turmoil in the market and the sentiment is risk-off, meaning that risk assets are again selling off, one potential beneficiary of that is, say, the risk-off asset, and that is like the 20 and 30-year bond. And again, there's also a nice correlation with this as well. Just bring it up. Okay, so just take a look at this. The purple line is the USD, the US dollar yen pair, and it's pretty hard to see because they're practically a mirror image of themselves. Whenever you see the yen strengthening, you see risk off, and whenever you see the yen losing value, you see rates going up. Okay, bonds selling off, meaning that risk on is back on the table, and that is really what we've been seeing ever since January. Again, continuing of that correlation, fairly nice correlation in my opinion. So again, what should you be looking at? You should be looking really at small caps, the Russell 2000, as a possible bellwether for what is to come. Again, one of the two is lying. Okay, so either the credit spreads are lying and risk is low, or really the Russell 2000 is, and you know, again, the stocks these small caps should be rallying much more. So keep an eye on both. Keep an eye on the yen. Keep an eye on inflation data coming out of Japan, and keep an eye out on economic data coming out of the US, because as I said, either inflation is going to have to move interest rates higher in Japan, or whether it is possibly the US economy slowing down. Those are two factors that can narrow the spread between the Japanese and United States interest rates. Okay, so look at interest rates, look at small caps, look at credit spreads, look at risk assets in general, and risk off assets. Just look at everything. That's what I'm saying. Look at everything. All right. I guess I'll leave it at that. I hope I did a good job of explaining what this carry trade is. I'll leave it at that. I'll see you next time. Again, if you like this kind of content, consider leaving a like, and again, see you next time. Bye.